The topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome and good Monday morning. It's a way to start your morning talking about nothing better than taxes. Maybe worse than that is IRS debt. I mean, if you got to start your Monday off talking about IRS debt, you need help. So I guess I need help, because this is what we're going to talk about today. And now I've got some questions that people have asked from previous shows that we want to answer, and we'll do that probably in the last segment and stuff. But, what do you do when you owe the IRS $10,000, $20,000? I mean, even $500, people are in a panic of what can the IRS do to me? And then, what should I do to solve this problem? And the solutions can run the gambit. I mean, you've heard the commercials on the radio stations and everything else across the country, TV, you name it, they're out there, soliciting you as a person that owes, $10,000 or more to get you help against the IRS. And, when you owe it, you're in a panic because you're receiving those nasty letters that the IRS sends. And, one of our previous shows, you can go listen to one of the podcasts. We went through all the different letters the IRS sends. But, when they get to that final notice of intent to levy and you get a certified letter, most people are in pure panic motion stage of the collections. What do I do now? We shouldn't let it get that far. You got to find the solution. But if you are that far, that's when you need to get a solution definitely in place, whether it's a do-it-yourselfer and you call the IRS and they take everything that you have available to pay them and put you on the biggest payment plan that they think you can afford, but at least it stops then collections until you default. And then you default and everything gets back to the same way and becomes nasty again. So, what are your options when you owe the IRS? It's, like I said, runs the gambit. The first option is going to be an IRS installment agreement, payment plan. Now, you've got to make sure before you do anything with the IRS, and the IRS will go through compliance with you as well. You've got to have filed all missing federal tax returns. Even if you can't afford to pay the balance immediately, before they'll set you up with an installment agreement or do anything else with you besides take your money in through liens and levies, wage garnishments, you've got to be 100% in compliance with your federal filings. They could care less about your state. I mean, this is federal government. If you haven't filed your state return, the state's coming after you. But, we're talking federally. Now, if you are in compliance for filing, then you now have options. And, the first one everybody looks to, or the IRS looks to, is payment plans. Now, you can run multiple different types of payment plans with the IRS. they do give you the ability to maybe do a short-term payment plan. They give you 180 days to pay the full balance. 6 months. So that's available if your combined federal tax, penalties, and interest total less than $100,000. Now, can you come up with $100,000 in about 6 months? If not, then you've got to maybe look at other things. If maybe this plan could be available to you, maybe you're going to go after a loan. So you're going to go after a home equity loan to pay off your debt. Hey, this short-term payment plan buys you the time to make those arrangements. That's all it does, is it's buying you the time to make those arrangements to pay that full balance off. So if you owe $100,000 or less, you can get into the short-term 180 days full pay installment agreement with the IRS. So not a bad plan if you're going after a loan, or maybe you're trying to pull some investments out or something like that you're going to pay off, and you need or want more time to pay the IRS. Now, they will also give you a long-term plan if you want it. This allows monthly payments for up to 72 months, 6 full years. Now, this is available if you owe less than $50,000 in combined tax, penalties, and interest. Now, the only reason they say it's available is because it is automatic if you owe $50,000 or less. Now, if you are owing more than $50,000, then you're going to have to provide financials, which is through a 433A for personal. And if you run a business as well, or you have a side business, or you file Schedule C, maybe you have an LLC or an S Corp, they may want the business financials as well, and that would be on a 433B. And you would have to provide both the A and B if you're running a business, and then they could give you up to 72 months. Sometimes I've seen them go out as far as 84 months, but the typical norm is 72. Unless you are running up against statute of limitations. So if your statute of limitations is only 60 months on your oldest debt, or 48 months, then they're going to put it on a lower payment arrangement. So you would have to pay it off within the statute of limitations. It can get complicated when you start dealing with the IRS and you say, hey, I was listening to Tax Talk for You, and they said we had 72 months. Not 100% correct in 72 if your statute of limitations is going to lower the number of months the IRS has to collect the debt. Now, statute of limitations is 10 years from when it's filed and accepted. And then they can add time for pauses in the statute of limitations from running, such as filing for a CDP hearing, filing for a couple of other statuses that we'll be discussing here coming up that can and do pause of statute of limitations. So some things to consider is pauses are not necessarily a good thing if you're trying to get the statutes to run out on tax debt before you full pay, or before you have to pay all the money to the IRS. Now, one of the things that with any installment agreement is penalties and interest continue to accrue on the remaining balance of your debt until you pay it off in full. But entering a payment plan cuts the failure to pay penalty rate in half. So there are some things that help you save money by getting yourself into a payment plan, whether it's a short-term one, long-term one. And if you've got the wherewithal to pay your $50,000 in tax debt, IRS even offers an online payment tool that you could go through and do. Now, you got to understand, it's going to be the maximum payment that they want is what it's going to calculate. Not going to give you any discounts. It's not going to lower it because you're in financial hardship. It's not going to lower it because your ability to pay is less than what they're seeing your ability to pay. Because when you go through and do the payment tool, it doesn't look at anything other than what you owe and how you're going to best pay. It's kind of their whole technique is to get as much money in to the IRS, Department of Revenue, as possible. So they offer that payment tool. Hey, go do it if you want to pay the max. That sometimes is what you've got to do and maybe the way you need to go. But it's going to impact you because it is going to be maybe a higher installment arrangement than you can actually afford to do. So, it's kind of one of those things that you need to be looking at to determine, hey, is this right for me? So, you have other things you can be doing to solve this debt. Now, one of them, and I really like this, especially if you're running up against statute of limitations, is the partial pay installment agreement. And we're going to go through that right after this quick break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We were talking about tax debt and what do you do when you owe that dreaded IRS? I mean, it's almost like, those handcuffs, and now they have you invisible handcuffs and you can't do anything. And man, the pressure that it puts on you, your spouse, your significant other, your family as a whole, because you're stressing. Are they going to take everything? Are they going to levy my bank account again? Are they going to garnish my wages? Are they going to garnish my Social Security? Are they going to put a lien on my house? Are they going to levy, take my house? All those things are the pressure of owing the IRS. And so, you go through dealing with this in life and, you've got to figure out a way out, to unbury yourself from this debt. And this payment plans, you can do it, but, again, if you can afford it, if you can't afford it, then maybe you've got to look at other ways of going about it. And one of the other options in installment agreements is what we call partial pay installment agreement. It's where we get the IRS to approve making lower payments to the IRS that doesn't pay off all the debt. Now, okay, how is that possible? Well, a lot of times you're running up against statute of limitations. So, maybe you got a year or 2 years in some of your tax debt. Maybe you've got them staggered and it's 1 year left, 2 years left, and 3 years left. and you can afford to pay only $100 or $200, whatever the number happens to be, but it won't pay off the debt in any of that period of time. Now you have other debt that's maybe still got 9 or 10 years left in the statute of limitations. So you're going to have a longer payment plan. But if we can prove to the IRS through the filing of the 433A, and if you have to, the 433B, we can prove to the IRS that, hey, based on these standards and the amounts that you pay, you cannot afford to pay the full amount. So you may have to pay $100 a month that would cover the debts, but part of your debts may be falling off in that 1, 2, and 3 year period. And you could save, $10, $20, $30, $40,000, depending on what you owe each of those years. And it puts savings in your pocket without having to go through this long drawn out period of trying to file maybe an offer in compromise. But also, it gives you the ability to prove too that you can't access maybe the equity in your house right now. Maybe your credit's too bad. Maybe you have other issues. Maybe you don't have jobs right now. There's a lot of different options out there, what the reasoning may be. Or maybe only one spouse is working and, we want to get through the statute of limitations versus filing, for an offer in compromise right now. So there's a lot of different reasons we can use this tool to be able to set you up for success, maybe in the future, and maybe even set you up for success, maybe an offer in compromise at some point in the future, depending on, what we can get the IRS to agree to and how much debt you have and what the statutes are. We've used this tool for a client who had a lot of debt falling off over the first 2-3 years of the partial pay installment agreement, but had very little current debt. So about 75% of their debt was going to fall off within this short window. And we were able to work with the IRS, drag it out a little bit where we got 1 year to fall off for the statute of limitations. And now we're got them into a partial pay installment agreement where they pay very little every month. And they're going to see a significant decrease in their debt. And then they'll be left with very small amount of debt that would be paid off in this payment plan within a year or two after all the debt falls off. So kind of a win-win. The IRS gets some money and our client gets the biggest win because they're spending very little in this partial pay installment agreement, and a lot of the debt is falling off. So it benefits them. Now, you do have a choice of possibly getting into non-collectible status. That is another option for you. So, if you were to go through the calculations with us and with the IRS and do the 433A and possibly the 433B, and we can prove to the IRS paying your tax debt leaves you unable to cover basic living expenses, then we can request that the IRS place your account in CNC, currently non-collectible status. This isn't permanent. It is a temporary halt to aggressive collections and aggressive activities going through like bank levies and wage garnishments. And so it will put a temporary hold on that. Your debt's going to continue to grow. And it's going to continue to accumulate penalties and interest, and that's going to compound on your tax debt daily. The IRS is still going to take any refunds you get from both federal and state tax refunds, and then apply them directly to your past debt. Generally, this status is around 2 years. If nothing's changed, it probably would stay that way. But if your income goes up, the IRS is going to come back and look at this again with you to confirm whether or not you can afford to pay. So, generally what we see is after 2 years, the IRS does a comparison to your tax return. Your tax return hasn't changed, and therefore they leave you alone. But all of a sudden, maybe you start making more money, you're going to fall possibly out of this non-collectible status, and you will have to reapply for the non-collectible status, or at that point, looking at other solutions to your problem. But it gave you a couple of years reprieve. It gave you a couple of years to reset your life and finances and get yourself back into better footing to accomplish this. Very rarely are we going to use non-collectible status unless we see statute of limitations again going to run out within that 2 years. Again, we're not going to do it unless you tell us that nothing is going to change in your life over the next 5 years or whatever the statute of limitations are that's going to take to run out. If you were to tell me that, hey, you got a huge job coming up and you're now going to make $100,000 a year or some big number, we're not going to want to put you in non-collectible status because they will come back and start full collections on you. We then would possibly look at the option of finding, maybe offering compromise, maybe a partial pay installment agreement, something like that, and looking at what can we do to save you, down the road. So one of the other items that we look at doing is penalty abatements, getting rid of those penalties that you have faced and add considerable amount to your tax debt. But you've got to have basically legitimate, uncontrollable circumstances like medical emergency, natural disaster, major disruption, and then we can go in and request relief. However, we're going to have to provide documentation to prove that you've made an honest attempt to comply with the tax laws, but we're physically, financially, mentally, natural disasterly, not able to actually file your tax returns or pay your tax debt. So all those things can definitely impact what happens in being able to get that non-collectible status so that you're not paying the IRS any money currently, and maybe go forward from there. So penalty abatements do work at times. It depends on the reason, the excuse. It's kind of like going to your teacher and saying, if you go in and say the dog ate my homework, well, you know what? The IRS isn't going to believe you just as much as your teacher didn't believe you. So don't go at penalty abatement with an excuse that your dog ate your tax return or ate your money. That just isn't going to fly. So, that being said, what do we all hear on the radio? The Holy Grail, the offer in compromise. We're going to talk about offers and compromises and how you can get it. Do you qualify? Right after this short break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Again, it's a great Monday. Great to be here and helping you guys talk about, your tax debt and what you can do, what you can't do, and can you achieve, the Holy Grail, that offer in compromise, OIC. Everything you hear on the radio and every time you talk to somebody when you call for help, first thing they say is, hey, we can get you an offer in compromise. You're going to be able to settle your tax debt for pennies on the dollar. Oh, hang up, run. Wrong wording. An offer in compromise that the IRS offers allows you to settle your tax debt for less than the full amount you owe. This is intended for the taxpayers experiencing actually true financial hardship. It's available for those that can actually prove they have financial hardship and have no assets, no ability to pay. So what the IRS does, it's going to review all the financial data, all the metrics, and evaluate your financial profile, your financial health, looking at your income, your household expenses, and the big thing that many people don't tell you when you're calling and asking for help is your equity in your assets. Particularly, most people, it's like equity in your home, 401ks, IRAs. Yes, your retirement accounts count. Investment accounts, maybe other real estate you may own. All that comes into play when dealing with the dreaded IRS. I mean, that's just what they're going to look at. If you have $100,000 of equity in your house, the IRS is going to look at that as an asset that's available to them to help settle your debt. So, when they go in and put your house in, and maybe your house is worth $500,000 and you have $200,000 worth of debt. The IRS says, hey, we're going to look at fire sale value, which is 80%. So your house value is $400,000. Per the IRS, you have $200,000 debt, you have $200,000 available. If your house value is $400,000 and your debt is $400,000, you have zero available. So, those are the things the IRS is going to be looking at. They're going to look at your household expenses. Do they give you everything that you actually pay out? Well, yeah, if your actual is less than national standards, I've never seen that. If your actual is more than national standards, they're only going to give you the national standards. So your house payment, when you're paying your mortgage and your real estate taxes and your homeowners association and utilities and everything else, depending on where you live, you get maxed here. But if your payment is $400 to $500 higher, they don't care. Household expenses, food, clothing. You may eat at a king's budget, according to the IRS, but they're giving you only the pawn's budget. So you need to lower your expenses down because the only thing they're going to allow is that pawn's budget. Anything over that, they think the IRS should have. So we've got to look at your finances. Hey, you got a family of four. You have two kids. They're both in college, and you're paying the college expenses. Not allowed. Yeah, they're maybe 19 and 20. They're still your kids. They can still be dependents, and you get to claim them. but you don't get to claim the money that you pay for their college education. Sorry. Maybe you bought them cars. So you got a car for you, your wife, you bought a car for each of your 2 kids, and you got payments on all 4 cars. They only allow 2, you and your wife. That's it. Kids, cars don't count. If they're fully paid off, they want you to sell them and give that money to the IRS. They're going to value that through probably Kelly's Blue Book like we do, and give some kind of value of the cars. If they need repairs and stuff, we get to deduct some of that stuff. But that's what they're going to look at. So, we've got to look and see how you qualify, if you qualify, and then how does this impact you? There are times we will not take you through an offer in compromise because why? Because we know through your track record and your history, even history working with us, that you cannot stay in compliance. And so offer in compromise is one of the worst ways to go for you because why? Because an offer in compromise puts 5 years of total compliance on you from the date it's accepted and total compliance from the day you file for an offer in compromise. So that could be 6 years, 6.5 years, whatever it takes the IRS to process this. You've got to stay 100% in compliance. Not 75, not 55, 100%. And what if you don't? What if you miss a filing deadline? What if you owe more tax money? All this debt comes flowing back. I don't care whether it's after the first year or after the 4th year. That debt comes flying back with all the penalties and interest and everything that should have accumulated over that time. It all comes back, and now you're back at square one. You might have been better off going to that partial pay installment agreement than going through this whole thing with offer in compromise, because the offer in compromise, while it was pending and while it's sitting out in accepted status, while it's still in good status, statute of limitations never run. So when all that debt comes flowing back after 3 years or 4 years, you got 3 to 4 years added to your statute of limitations because of that pause. So maybe that partial pay installment agreement was better for you. Now, how do you know? Well, I'm going to be honest. One of the ways you know is you call somebody like Taxation Solutions Tax Relief. To go to taxationsolutions.net or give us a call, free consultation, free call, 888-930-1016, 888-930-1016. Tell them you heard it here on Tax Talk for you. Get a special discount just for listening to the show. Listen to me rant and talk about IRS solutions to your tax debt to save you and your family. That's the best way of going through and do it. Now, a couple other things about, IRS offer in compromise. IRS website, you can go to irs.gov, look up offer in compromise. You can see all the rules and everything there. They also have a pre-qualifier, so you can look in there and kind of test to see if you're going to qualify. But remember, this is very vague, and it doesn't always tell you the truth. There's always things sometimes we can modify that are happening in your household to help you qualify. And, we can go through and do it. And then the IRS does charge application fees because you're going to file that 433A. If you have a business, the 433B and the Form 656. And with that Form 656, you have to file the application fee, which is the $205 and an initial payment of the money you're proposing to settle for. And unless you are considered to be a low income taxpayer, you got to pay both of those in. But if you are a low income taxpayer, we can get a waiver on both the initial payment and the $205 application fee. So that is available there for you as well. One of the things that I want to be able to tell you is, we all hear the radio, we get phone calls from people saying, hey, they're either with the IRS or they're with somebody and you owe thousands of dollars to the IRS. And if you do, sometimes you fall for these scams, but you got to avoid them. I tell people to be highly cautious of people that are very aggressive in, a company promising just to wipe away your tax debt for, that the dreaded 4 words, pennies on the dollar. You know, do not want to have somebody that is going to promise you the moon, the stars, and everything else, and have never done an analysis with you. And that's one of the reasons why we start with a tax analysis, to be able to fully go through everything that you need to do, because maybe the IRS is completely wrong and we can find a different solution to the problem by looking into the account to do it. Maybe you haven't filed all your tax returns and we got to get those in compliance as well. Maybe you have more assets and they're not aware of them and never asked you the question, and you cannot settle for anything. You're going to have to go into an installment agreement. The IRS warns about offering compromised mills. Hey, there are some good companies out there. There are some bad ones. TaxationSolutions.net has an A+ rating at the BBB. So you can check Taxation Solutions out and see their rating out there, and know that we service people. We give you that free consultation and free call. Again, it's 888-930-1016, 888-930-1016. Give them a call. Give us a call and let us know that you owe money to the IRS, and let us find that solution to you. Just got to watch out. People making promises that they can't keep. We have people hang up on us because we tell them point blank, based on the information they're giving us, that you don't qualify for an offer in compromise. And therefore, we're not going to go after that. We're going to have to go after one of these other solutions out there and figure out the best solution, for you. And that's what we need to do to make sure that, hey, you're going to stay 100% in compliance. Here's some questions from some previous shows, and I'm going to go through some of those questions right after we take this short break. If you got questions about IRS tax debt and settling your debt, hey, get them in quick so we can get those answered as well. We'll be right back after this.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
All right. So when we're always doing the show, we get questions, and sometimes we do the show, Ask the Experts as well. We get questions over there that come in after the fact. We had Candace asked a question about S Corps. Now, she has heard all throughout Facebook, and I see it all the time, that, hey, you got an LLC, you got to make it an S Corp to save money on taxes. Should I become an S Corp? Well, that's generally a lot of times the question. Is it the right way to go? Should I take my LLC and make it an S Corp? So what they're proposing when they do this is setting you up as an S Corp so that you're on payroll, and so that you're receiving a reasonable salary for the work that you do in the business, so that you're getting paid less than your typical net profits. So if your business's net income is, let's say 100 or 120,000 or something, and you set your payroll at 50,000, well, what you're doing is saving the self-employment tax 15.3% between, that 50,000 that's of your payroll and that 100 or 120,000, which would be normal, your net income. So your net income would drop by, 50,000, but you received it in payroll. And so therefore you'd be saving 15.3% on that 50 or 70,000. So on 50,000, you're talking about, right around $7,500. So yes, that could be a smart move. But if you're only netting, 40 or 50,000, then, you're adding expenses of actually doing a S Corp tax return along with the cost of doing payroll. So you've got to take those things in account. So depending on what you're paying for both of those, you can deduct that amount of money out of that 7,500, and that's what you're keeping. So if you're right at break even when you have to do a reasonable salary out there for working in the business, then all you're doing is losing money paying the payroll service provider and paying for the S Corp return to be done. So whatever that may be, if you're already doing payroll, then it's not an added cost of adding yourself to payroll, but you still have the added cost of filing the S Corp return. So, we go through and do analysis for every company that we're doing bookkeeping and taxes for and determine, hey, is this the right route? Should we make you an S Corp or not? And we look at every company that is a single member LLC or sole proprietorship every single year to determine, what status should you be in. Now, if you're an LLC and you're married, you could always make it possibly a multi-member LLC, which you can then file as a partnership and then take away the need for payroll and have guaranteed payments, which is the only thing you'd be taxed on for self-employment taxes as well. And so you have that ability to manipulate things there as well. Kirk had asked us about the difference between filing taxes on your own versus business taxes. Now, if you're running a business, and depending on how your business is set up, again, if it's partnership, you're going to file 1065 and get a K1 to your personal. If it's an S Corp, you're going to get a K1 from the 1120S and file it on your personal. If you're running a single member LLC and did not make an election for S Corp, you're going to file it on Schedule C. If you're just a DBA, you're going to file it on Schedule C. If you are a corporation and did not make the election for S Corp, so you were Inc., then you would file an 1120 and the entity pays its own taxes. There's some advantages to that. There's some ways that you can use that to your advantage. But again, you've got to sit down with your tax preparer to make what's the best decision. The one reason I love businesses not being on the personal tax return besides a K1 is it takes all the trash off your personal return and puts it on a separate return for the business. Businesses are known to have a very low audit rate. Personally, on Schedule C, those audit rates are much higher than they are as a partnership or an S Corp out there. That being said, you got those more expenses. And if you have all your numbers 100% correct, because you've been using a company like truckertaxtools.com to do your bookkeeping, you would have less to worry about because we already have the I's dotted and T's crossed and you don't have to worry as much. But again, sometimes why set yourself up for that when you really need for other reasons to be on an S Corp return or a partnership return. And again, it takes the trash off your personal return and puts it over there. So some things to consider. Now, you're still, when you're getting a K1, you're still getting taxed on the net income from the business from the K1 coming out of that S corp or partnership, and the company doesn't pay tax, which is a good thing, because if you're an 1120, your company pays tax, but when they distribute money to you, it's like a dividend from Exxon or McDonald's, and that's taxable to you as well. So it's considered double taxation. So those are the types of entities you would look at. Most of the time, unless you have high income coming in and want a whole bunch of other benefits and it's only you in the business, then you could look at an 1120 filing. But it's using a lot of defined benefit plans and medical type reimbursement plans and a whole bunch of other stuff that we can go through and do. Oh, Candace, you're listening today. Awesome. Have a follow-up question. Would it be better to have a LLC or a Inc. as a startup? So incorporated business being a corporation or an INC. So you got Widgets LLC, or maybe Widgets Inc., or maybe Widgets Enterprises Corp. or Widgets Corp. That LLC is a great way to start because it actually is less paperwork. It can actually be your first year maybe on Schedule C. But if you're making a whole bunch of money, or your business plan shows that you're going to have a lot of money coming in and you got contracts out there that are paying you really well, that LLC can make that election, within that first 2.5 months of startup to be an S Corp. Or maybe we're towards the end of the year and we can wait till the next year in January, February, or by March 15th to make that S Corp election. So that LLC gives you functionally the flexibility to be a Schedule C versus being an S Corp out there as well. So you have a little bit of flexibility. And, some of my attorney friends say, hey, the paperwork behind an LLC is a little bit easier. Most people don't keep a full corporate book for an LLC, especially if it's a single member. Now, if you're a multi-member, you're going to want that corporate book, especially if it's external to family or external between, not you and your spouse, but maybe between you and your brother or your sister or other family members, or you and somebody that you're just friends with that you're going into business. You'd want that corporate book to dot your I's and cross your T's and make sure that everything is going correctly. And then you want some good bookkeeping services to help you as well. Because again, whether you are a single member LLC, multi-member, or an S Corp, you want to make sure the numbers behind your tax return are really good as well. So, that's what you're going to be looking for. And like I said, you have that flexibility as an LLC to do taxes in different forms. I mean, we could actually, if you're married and happily, and you want to add your spouse onto the LLC towards the end of the year, then we have the ability to do that as if they've been there the whole time. There's a little bit of flexibility to look at as you're going through and doing it. One of my attorneys, the friends that I have, recommend going that route versus the corporate route, because you're automatically having to either file for S Corp status or you're automatically having to file an 1120. When you file for your employer identification number, it's going to lay out everything that you've got to do, including whether you have to file 941s and payroll and everything else out there. Man, time flies when you're having fun talking about, taxes, helping people through their tax debts, and what we can do to solve their tax problems. That starts with making the phone call to taxationsolutions.net. Taxation Solutions Tax Relief. Again, A+ rated at the BBB. Phone number is 888-930-1016. Again, 888-930-1016. Hey, and as always, you can find us here every Monday at 10 a.m. Eastern Time on W4CY Radio. You also can go to Facebook and follow us over there. Follow us at Tax Talk, the number 4, letter U.com. Again, Tax Talk, the number 4, the letter U.com. Follow us there. Never miss an episode. And if you do, we're on iHeart, Spotify, all the podcasts, web hosting sites. Get over there and see it. Come back, and if there's something you want to listen to figure out, that's where to go and catch one of our podcasts. But again, it's taxtalk4u.com. Hey, thanks again for tuning in. Hey, have a God bless and glorious week, and do what you love, and hey, love your spouse. Have a great week. We'll see you next Monday, 10 a.m. Eastern Time, right here in W4CY Radio.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalk4u.com. See you next week at W4CY.com.